were looking at basically, the 10-year paper. Okay. Now, if you look at a 10-year, bond in India, currently the government is, issuing bonds at the rate of close to about 7.27. So every Wednesday when the government comes and issue bonds, the bonds are issued very close to the current yield, which is the current cost of raising money by the government. Okay. Now, if you look at the trajectory of these bonds, look at this historical data. Fine. So this is tells you about the 1 year kind of a time frame how the bonds have reacted. So if you look at a year back, right, in the month of December, January or December last year, the bonds were hovering around 6.36, and then the interest rates started rising up, and it touched a peak of 7.57%. So government was able to raise the money. The government raises almost like 15,000 crore per week, and they have a huge borrowing program which runs into several lakh crores. So and then why the interest rates started going up? Any reason? Anyone? How come the interest rates started rising up, and we witnessed everywhere in the world the interest rates were rising. Okay.
There was a lot of inflation uh, that has
Yeah.
come up. So to
Yeah.
tame the inflation,
Now, of course, to tame the inflation is the second part. Because of the inflation was
quantitative.
rising, because there was a Ukraine war, and the all the commodity prices started going up. The crude price touched about close to about $130 a barrel. Of course, now it's cooled down a bit, back to about $85 a barrel. So even aluminum, zinc, all commodities which India consumes for manufacturing its products, the cost had gone up. The cost of even the if you look at the WPI or the CPI, the retail index, and the commodities, the wheats, everything, the sugar, all the prices have gone up all over the world. And there was a wheat shortage everywhere. So, which led to a high inflation. The possible reason was because of the, start of the Ukraine war. And because, one of the thing was because during the COVID time, many governments of the world, they started, pouring money, giving money, free to the people, so that, I mean, free ration, free, I mean, money to bail out, people from the COVID issues. So, and largely led by Ukraine war further multiplied, all this, and the inflation started rising. In USA, the inflation had touched around close to about 10%, where the inflation is around only 1%, not half a percent there. So we saw that the yield had started going up. Okay, so this is the rate at which the government borrows. So if the government borrowing cost goes up, then the cost of borrowing, of all the companies in India also goes up. So which is not a very good news, because if the cost of capital goes up, then the company, makes, expansions don't come so easily. Companies don't commit capital expenditure because they find that, raising money has become very costly. But now, then after that, somewhere in June, the inflation started coming down, and it peaked at a lower side at 7.17. Okay, and then slightly a bump up, and again the trajectory is that it has been coming down. It's close to about 7.27 as of today. Fine. So this is the rate at which the government is borrowing. Now, if the any corporate has to borrow, they have to borrow it at much higher rate than this. It will depend upon the rating. So we'll understand that. Okay. So so that is I was trying to explain. If suppose the let's look at the operating profit of the company is 120 crores or whatever you can think, and interest cost is say 15. Fine. So, what we calculate is basically the interest coverage ratio, which is interest coverage ratio, which will be,
Eight.
this divided by this. Okay. Now, if it is 8, that means the company is earning 8 times more than what interest they have to pay on their loans. Okay. If suppose this comes down to just say 60, so company will be in big problem, because if the profit dips further, suppose it goes down to 40, then it will keep falling, and the company will not be good. Okay, so if the company is having say about 150 companies, having an interest coverage ratio close to about 10, okay, or 8, then what happens is then all the credit rating agencies, they give a rating which is close to triple A. Now this is one of the criteria, but of course they look at the future growth of the company and all other parameters. So, but this is one of the main criteria to looking at, because it includes the operating profit of the company, how much profit the company is doing, and what is its current borrowing and what is its borrowing outflow in terms of interest. So the companies which have interest coverage ratio, very good coverage ratio, would generally mean those companies are doing well, and they even like to project how much company would be earning and what will be the interest cost. So they do it for 3-4 years, okay, and then look at how the interest coverage ratio will look fine in future. So if they find that the interest coverage ratio is good, then if it is stable, then they will give a AAA rating to the company, as we can see in the chart here. Like here, like one of the valuation expert or father of valuation called Damodaran, he publishes a number every year. So let's look at these two numbers. This is the number when the company is a low market cap, and this is a high market cap. Of course, the definition of market cap is not been defined here, but generally a big company like Reliance, SGFC, Infosys, HUL, Asian Paints, they will all come. Top 100 companies of India will be high market cap. Suppose if Reliance is having a rating of triple A, okay, so that means 0.75 will be added to the current rate.
7.277.
So 7.27 is currently the GSEC rate which the government is borrowing, and we will add 0.75 and to arrive at the cost of capital of Reliance. Okay, suppose we want to calculate what is the cost of Reliance. So this is one way. Okay, this is a very simple way. Of course, it comes with a lot of other, I mean, this is just a thumb rule I'm telling you. So that means the cost of capital of Reliance. If you are not able to get the cost of capital of Reliance, this is the current market, cost of debt of Reliance, which is close to about 8%. So if you look at Reliance, for example, if you look at Reliance, then if you go to screener and look at what is the current rate at which they are borrowing. So let's see if we find that number somewhere in the screener and look at Reliance, okay, and go to the documents here. So look at like for example the credit rating here. So the credit rating of the company is AAA. Okay, fine. So maybe somewhere they might have given, if you search, you will find, at what rate the company is today borrowing. So what is the current rate? So I am not able to see them. Okay. So, but you will be able to find, at what rate the company is borrowing. So that will become basically, that will be very close to about 8% or thereabout if, we follow this mechanism. Of course, this is related to the US companies, which, the Damodaran has picked up all the US companies and tried to calculate what would be the spread, but normally fits into the Indian scene also. Okay. So that is the way we, generally work out to find the cost of capital. We take the rate of interest at which the government borrows and add the credit, risk spread, basically, I mean, related to the rating of the company. Okay. Suppose the company has, a low rating, for example. Okay. For example, if the company has a rating of say triple B, then we are going to add 2.727 or rather 2.25, the same. Okay. So it's almost the same for all the companies, it seems. Okay. So we are going to add 2.25. For example, DLF, assume that, its rating is triple B. So that means, it will be very close to about, 9.5% would be the cost of capital of, DLF. Okay. Is that clear? Is that
Yes,
clear
sir.
to you? Okay, to all of you? Sakshi, any questions? Rupak?
No, sir.
So if you want to calculate the cost of any company, cost of debt of any company, so what are the various, what is the cost of debt of a company basically? Cost of debt of the company is what is the rate at which the company is, currently, taking money from either raising bonds or going to bank, and what rate of interest they are actually being, charged. So that's the cost of debt. We take always the current cost of debt and not the historical. At what, at what rate they have borrowed, say 3 years, 2 years, 1 year down the line. So whenever we are valuing a company, the current cost of debt becomes more important. Okay. So how do we arrive at the cost of debt of a company? Sakshi, just whatever I've said, if you can just say something about it, or anyone, Rupak, Vyom, Divya, Akshay, anyone who is present. So how do we arrive at the cost of debt for company? Yeah. Vyom, yeah.
So, sir, what we do, the GSAC yield is given to us, like we have seen is 7.27. So, company has a particular rating attached to it itself, like AAA, like Reliance AAA, or any other company which has triple B or something like that. And there is attached additional interest that because the company have to take a debt at a much higher interest than the GSEC, the government bonds. So
Wow.
it will be added on the GSEC and we will arrive at the cost of debt for a particular company,
Yeah, yeah,
like in case of the
absolutely, Vyom. No, actually, what happens is the logic is basically because the government is a kind of because it's called a risk-free rate. Okay, now of course there are some people like Damodaran. They say that the risk-free rate, which is 7.275%, we have to adjust for the country's rating also because the India's rating is triple B. Okay, so if India rating was triple A, then the risk-free rate would have been 7.27 because since the rating is triple B, we have to even adjust the risk-free rate and bring it down. So it will be somewhere around 4.5% will be the risk-free rate if we minus the credit risk attached to India. Okay, so that is one more thinking. But anyway, so if we assume that risk-free rate is 7.27 and we don't make any adjustment to that, we simply add the credit risk related to that company. The credit risk spread which Damodaran has given related to all the companies which are rated at various scales. So to arrive at the cost of debt. So this is just a kind of a ballpark number we can arrive at. Of course, cost of debt is very difficult to find as the cost of equity, but we can always make some estimates based on the risk-free rate and add the basically the default risk associated with that company, which is reflected into in a spread. Yeah, come on. Yeah, what do you say?
Sir, sir, is this government security rate after tax YTM?
No, it is not
Otherwise, I
after.
mean,
No, no, no.
if
Rupak,
it
this.
is not after tax, then since the born to Reliance would provide the tax shield, then they can borrow cheaper than government. Then like if their cost of debt is 8%, then if 30% tax, to they can borrow at let's say 5.6% only. And
Rupak, actually, your observation is absolutely right. When we arrive at the cost of a debt of a company, then we have to do 1 minus T to it. Whatever rate we arrive, like suppose, I arrive at a rate of, debt of a company like here, okay, 0.8. Now, suppose the tax rate of suppose effective rate of tax rate is 25% of Reliance, okay. So what will be there? It will be, that means, we will be doing 1 minus T. So which will be basically, 0.75. So that means the cost of debt, adjusted cost of debt of, Reliance would be basically this. So this will be the cost of debt of Reliance. Okay. Now, as far as you're saying it will go down below the risk-free rate, it's okay, fine, it doesn't matter. So cost of debt is of Reliance is 6%. Okay. And then we look at what is the cost of equity, and we calculate the weighted average cost of both cost the weighted average cost of capital of Reliance, both including the debt. Suppose debt is, for example, say only 10%, okay, and 90% is equity, okay. Let's assume that the cost of capital is say 15%, cost of equity is 15%, okay. So then we will say that what is the cost of capital of sorry, what is the cost of um, so if we want to arrive at let me just use here, okay, so we can just arrive at a weighted average cost of capital of, suppose this is the cost of equity. I'm saying this is cost of equity, using the CAPM model. Suppose we have worked at 15%. I'm not going to the details, and this is the cost of debt. So these are the weights. 10% is the debt and 90% equity. So we'll say that the cost of capital, the weighted average cost of capital, we say the WACC is is 7.3%. Okay. Rather, this has come to 7 point. This should be simply added. Okay. Fine. So how it is coming? This is actually zero point 0.5. Fine. So I have to just do a format of cell. So this is, this is 6%, okay, and let's say this is 15%. Fine. So then we simply add them up, okay, and we say that it's 14% somewhere, okay, 14% it will be, okay. So 13.5 plus 0.6, so it will come to 14%. So this will be the WACC of Reliance, okay. Is that clear? Any questions? Have you calculated the weighted average cost of capital of any company? Anyone? Sai?
Yes, sir. We did it in a previous course.
Ah,
The cost of equity and cost of debt we
okay,
calculated and then added it. Yeah.
sure. Okay, so let's now go back to our understanding about the mutual funds. Fine. So let's go to uh, money control. So we'll start from here. Okay, fine. If you remember, we were doing equity. Okay, fine. So we did debt also a little bit. Now we are left with hybrid and solution oriented and others. Okay. So just to recap, so what are large cap funds? Anyone? Any idea what are large cap funds?
So the
Which in
companies whose market cap is more than 47,000 crores in India.
Okay.
The top
Ah,
100
so
companies are called large cap funds.
So that means a company, a fund which is largely towards all the top 100 companies of India. Of course, it will have some components of small cap and mid caps, but more than 70% or 80% would be always put into large cap companies. Okay, fine. Then we have large cap and mid cap. Then we have small cap contra funds. As I told you that they invest into equities which they think that they are going to do well now after a persistent fall in their value, and they feel the time has come that these companies will do well, but this is contrarian to the view of the market. Okay, so they try to find out very early or sense a very early recovery of these companies, so they start putting money into these funds so that they can give a return. Then ELS is what? What's the full form of ELS?
Equity linked savings scheme.
So basically, here it is that normally what happens is that many people want to know where they should like to put their money to save tax. So if you look at data here, so this is all this thing. So we can look at like a kind of a 6 months return because that has become more better to look at. So of course this is UTI long term equity fund tax saving is giving you 14%. Okay, fine. And if you just uh, uh, sorted on that mechanism, so which is the fund which is giving you the maximum return? Suppose you want to advise someone where he should put his money to save income tax. So just name three funds according to you where you like to put.
Coupon tax plan, Sundaram Long SBI Long Term Advantage Fund.
Yeah, so these are the funds which are giving, in the last 6 months, they are giving about close to about 20%. Okay. Sundaram, SBI, okay, and these funds are giving a good return. If you look at even a 1 year return or a 2 year return, if you want to look for a long term kind of a, this thing that, who has performed, then, you find still Quant Tex Life is giving you about 45% return in the 2 years CAGR return per annum. Okay. Sundaram has also given. So you cannot keep advising people to invest into these funds because these funds have given a remarkable return over a 6 months time frame as well as 2 year time frame. So you can download the data and further analyze. And of course there is always I told you that there are some risk ratios also which are given. Okay, so you should always not forget to look at the risk ratios. Fine. So here, the risk ratios are standard deviation. Okay, beta, Sharpe ratio, Jansen's alpha, Trainer ratio. Okay, so these are the ratios which are given. Fine. So, fine. So, do you know? I mean, standard deviation and beta, we all know that higher the standard deviation, higher will be the risk. Lower the standard deviation, lower will be the risk. Okay. And beta also, if it is more than 1, so we say that it is riskier compared to the market portfolio. And if it is less than 1, we say that it is, less riskier. So we will like to choose, a fund which is less on risk. Okay, fine. Now coming to Sharpe ratio and Jensen alpha. Have you heard of the term Sharpe ratio? Anyone?
Yes, sir.
So basically, what do we do in Sharpe ratio?
The
So what does the Sharpe ratio tells you? What is the Sharpe ratio? The lower the better, the higher the better.
The higher the better, sir.
Yeah, basically, as you all know, the formula for Sharpe ratio is basically the return given by the fund minus the risk-free rate, okay, divided by standard deviation. Okay, so that means it is telling you that how much return you are getting per unit of risk. Okay, so higher it is better. Okay, like suppose I'll just explain that on a basically an Excel sheet here. Suppose there is a fund, okay, which is giving you about 16% return. Fine. And suppose the risk-free rate is 7.27. As we know, it is this is the current rate. Okay. Fine. So what is the return you are getting above the risk-free rate, which will be 16 minus 7.27. So you're getting 8.73% return over the risk-free. Okay. So I'll just put the 8.73. So this is the risk-adjusted return. Risk-adjusted return. So that means after adjusting the risk, this is the risk adjust. That means you're getting 8.5% or thereabout higher return if you take a risk. Okay, because if you don't take a risk, you will be earning 7.27. But since you have taken a risk and putting your money in a fund, so you're getting a premium, risk premium of 8.73%. Okay. Now we look at the standard deviation. Suppose the standard deviation is 20. Okay. So what we'll do? We will divide this by this. So we'll have 0.43. Suppose there is another fund. Assume there is another fund. Okay, who's risk free. This is he is giving 12 say 12% return. Okay, fine. And the risk free rate is, for example, we know the same. Okay, fine. So what is the the difference here? Minus this. So we have 4.73. So I'll just put it 4.73 here. Otherwise, it will complicate this thing. Suppose the standard deviation is just 8%. Okay, so what we do is we take the return divided by risk. So the Sharpe ratio, this is called the Sharpe ratio. Okay, Sharpe ratio. Now tell me which fund is better according to you and why? Anyone?
The second one, sir.
The second one is better. Okay, why the second one is better?
Because
Yeah,
it is
come
giving
on.
more return for the same amount of risk we take.
Absolutely. So that means the risk per unit, the return per unit of risk. So what we say is return. Now here it is the return, risk adjusted return, not the return, but risk adjusted return, per unit of risk. Fine. So this will be, adjusted return. What do you call? Risk adjusted return. Okay. Fine. Or so this is basically. So I'll just put return. Okay. So return per unit of risk is higher here. So this is the fund which is giving you 0.59. So higher the Sharpe ratio, better it is. Have you followed? So
Yes,
let's
sir.
go back on the screen now and to understand. Okay, Rupak, would you go for a higher Sharpe ratio or a lower Sharpe ratio?
Higher Sharpe ratio, sir.
So higher Sharpe ratio is always better because higher it is.
Yeah.
Yeah.
For
So now,
higher return
yeah.
per unit
So
of risk taken.
absolutely. So if you look at this, then you can just sort it according to this. Okay. Then you can just sort these plans and look at the quantum tax plan, which was the top of the table. The Sharpe ratio is the highest. Okay, so that means it is giving very good return, and the standard deviation also looks to be, if you can just sort it on the basis of the beta also. Okay, and the Sharpe ratio, but the Sharpe ratio is taking care of the standard deviation also, so that becomes the ultimate. So any stock which is, or any fund which is giving a higher Sharpe ratio would become your favorite, where you should be putting your money. Then we come to Jensen Alpha. So have you heard about Jensen Alpha?
No, sir.
Okay, now I told you that suppose, for example, suppose the Sensex is a bench. Suppose there is a large cap fund. Okay, a large cap fund. Fine, a large cap, which means it has invested in the top 100 companies of India. So what would be the benchmark? Will be either Sensex or Nifty, because these are the two benchmarks which invest into all majorly into the large cap companies of India. Okay, so if the Sensex has given you, for example, if the Sensex has given you a 12% return over a period of 6 months, okay, and this fund, okay, we're talking about this fund scheme, okay, this has given you 14% return, okay, or 15% return, then the alpha would be 3%. So this is the alpha which the fund manager has earned for you, because he has put money into those stocks, 100 stocks, which are giving you much higher return than the benchmark itself. Okay, so he has generated an alpha of 3%. Have you got it? So what is alpha then? Anyone?
So anything which is earned by the portfolio manager above the index
Above the benchmark,
benchmark.
okay, whether it is a Sensex, Nifty, or BSE 100, or mid cap index. Suppose it's a mid cap fund, then how much the mid cap fund has given a return compared to the mid cap index. So if it has given more, then we say that the fund manager has generated an alpha for you. Is that okay to everyone? Is that clear? Any questions here, please?
No question.
Is it simple? Sakshi, is it simple? Have you understood?
Yes, sir.
Okay, so let's go back now. We were at where we were. Let me just find out where we were. We were in the basically this one. Okay, no. So this is there. Okay, so Jensen Alpha. So now we can just sort it on the basis of Jensen Alpha. So we should be putting our money, basically. The first one is just the advertisement. So you can just block this. The which is the best fund which has given you the maximum alpha. Name just 3 funds out of the mentioned here. Sakshi, which is the fund which has given the best alpha?
s-
Which is the fund which has given the best alpha? Look at the highest number here.
yes, sir. It'll be the first one, that is Quantax plan. And sorry, the
Okay.
DSP tax, that is an advertisement, right? So the next one, the Quantax plan, direct plan growth.
Okay. And what about Prachi? Which is the second best?
So it would be SBI Tax Funds Series Third Direct
Okay.
Plan Growth.
So what is Janssen Alpha?
So, sir, it is basically the return that the fund manager has gained for you over and above the benchmarks.
Yeah, absolutely right. Now we come to the trainer ratio. Any idea what is trainer ratio? Anyone?
So the ratio which the fund manager would take, is that the one?
So trainer ratio, if I'm spelling it right, trainer ratio. Okay. So basically, here, what the trainer has done, he has taken the beta instead of standard deviation. Okay. So he takes beta. Okay. Suppose the beta of a company, of a fund, for example, let's say that, there is a fund which is given you a return of, say 14, 15%. Okay. And the risk free rate is, say, same as 7.275%. Okay. And say beta of the fund is, say, 1.35. It's risky. Okay. So how do we calculate? We just, minus these two numbers. So we arrive at 7.73, and then we divide this 7.73 by 1.35. Okay. So this is 5.72. So this is called the trainer ratio. So higher the trainer ratio, better. That means, again, this is a risk adjusted return per unit of market risk. Okay. So there in the Sharpe ratio, it was, risk adjusted return per unit of total risk. So here we just, take market risk, because, what trainer felt was that, people who are investing in portfolios, they are more, inclined towards looking at the beta rather than the standard deviation, because, they are invested into portfolio. So since they have diversified away their, their risk, they only now, their company specific risk has gone out of their portfolio. They are only now having market risk. So since they are, only dealing with the market risk, so trainer ratio is better, because it captures, risk adjusted return per unit of beta rather than risk adjusted return per unit of standard deviation. Is that clear to everyone what I said? Can anybody just repeat it? Why trainer ratio is better than Sharpe ratio?
Because it eliminates uh, it.
The
I mean, it
company
only
specific risk.
considers the market risk, but not the company risk.
Now tell me why, why the company risk is not important according to him. Why the market risk is only important? Because, when you are investing in a portfolio, if you are invested in 20 stocks, okay, what happens is that when you invest in 20 stocks, so the company specific risk gets diversified away. Some companies are losing, some companies are gaining because of their own, kind of a situation, not because of the macros, just because of, their own issues. That suppose there could be a lockdown in one company, there would be, a kind of an upside in the stock of one company, because, they have, the strategies were very good and they were able to implement them well. So because of the company specific reason, if there is any gain or loss, okay, so that gets diversified. If you are invested in a large portfolio, so that gain loss will be, cancelled out, because some companies you will be making money, some companies will be losing money on account of the company specific reason, and that gain and loss will be lost. Only the risk which you will be riding when you are investing into a portfolio is the market risk. Okay.
Got it.
Now, since you are not just taking a market risk because you are in a portfolio, so the beta becomes more important rather than the standard deviation. Is that clear? Is there any question here? This is a very important concept. Okay, fine. So you must understand that. Okay, tell me now. So when we invest in a portfolio, which is the risk which we are looking for? The market risk or the company specific risk? Which we want to, divert, which is, affecting our returns of the portfolio?
So the market risk.
Market risk.
Market risk. So what happens to the company risk, Rupak? Then
Since we are
why the person is not in
since
the, yeah.
since we are investing in portfolio like multiple companies, then in overall the market the company specific risk nullifies.
That nullifies, that cancels out, because if we are investing in, say, 20 companies, 10 companies may, do very well because of their own reason, 10 companies may not do. So 10 may suffer a gain, suffer a loss, and 10 may gain. So that gain loss gets, washed away, when you are invested in a portfolio. So that means you are left with only a risk, which is called the market risk. And the most important risk measuring factor is the beta. So according to trainer, the beta is more important. Okay, so the trainer ratio assumes more importance rather than the Sharpe ratio. Okay, is it clear to everyone? Adarsh, is it clear to you? Adarsh, should I explain again? Anyone? Please tell me.
Yes, sir.
No, sir.
Should I explain again?
Yes, sir.
Okay. Now, if you are, listen to me very clearly again, just focus. Now, suppose you have invested, for example, long back, about 20 years back, I had bought Maruti. I had no other stock. So somebody said Maruti is going to do very well. Okay. So Maruti was trading at, 1,000 rupees at that time. And I bought it. Somebody said it will double in 2 years' time. So I was very happy. So I invested lakh of rupees. But unfortunately, there was a strike in Manesar plant and there was a lockdown for 1 month. And the stock price tumbled from 1,000 to 500 rupees. So my amount which I invested 1 lakh became 50,000 rupees. No, I was taking two kinds of risk. One was the company specific risk, and other was the market risk. So which risk hit me? The market risk or the company specific risk?
So the company specific risk.
Company specific risk. So it became, suppose I had invested, if I had invested 1 lakh rupees, not all in Maruti, but 5,000 rupees in each of the stock like Reliance, Maruti, Infosys, Hindustan Liver. I spread all my money into 20 companies. Then, even if there was a strike in Maruti, I would have lost, only 2,500 rupees instead of 50,000 rupees. Okay. But I might have gained, in some other company because of, some positive development or news. For example, Reliance might have discovered a new oil well, and, Reliance share would have gone up by, say, 50% or 30%, whatever. So, whatever I lost in Maruti, I would have gained from Reliance. Or net in 20 stocks, I would have lost in some and gained in some and lost in some. So, I would have found that, as far as the, company specific risk is there, I have not gained nothing. Some companies have done well, some companies have, done, not well, but I haven't gained anything. But, the only risk which I cannot diversify away is basically the market risk, which is the risk, related to the macro factors. For example, if the interest rates, because of the monsoons in India, which is a kind of a macro factor, the interest rates going down and up in India is, or in the world is called the macro, kind of, risk. And, there can be, oil prices surging in the world, and, it can be again a kind of a macro risk to many companies because, things become costlier if the crude prices go up, inflation go up. Okay, so these are all macro factors. So that is a risk which I cannot, diversify at all. So that risk is, basically measures in beta. Beta measures that risk. Okay, the company, the market risk. Okay, so according to trainer, if we want to know, which fund is doing better, which not, so we should look at the, the fund which is giving you the higher trainer ratio rather than the higher Sharpe ratio, because the Sharpe ratio, captures the total risk. Okay, which is both the market risk and the company risk put together. So since you're in a portfolio, you should be always looking at the trainer ratio or the beta of the company rather than just, focusing on the standard deviation. But if you are, just, trying to analyze only one stock, then the standard deviation assumes importance. Otherwise, the beta assume importance when you are invested in a portfolio. Is that clear to everyone now?
Yes, sir.
Okay. Any questions, please? Any questions? No. So now, look at this, trainer ratio. So I'll just, you can just download all the data on your Excel sheet later on and look at, the trainer ratio. So which company, is giving the highest trainer ratio? Forget the top one, because this is just a, advertisement. Now, which is the company which is having the highest trainer ratio? Anyone, please?
SBI tax advantage.
No, sir, the quant.
Both are having almost the same. And, on the top, the quant is a 5-star rated. Okay, fine. It is rated, CRISIL rank is 5-star. So everybody, it seems, is, all the ratios are also tilted towards, the quant. Okay, and it is giving, as far as the return it is giving, it is, look at quant, 2,000 crores have been invested in that. Okay, but this is not the biggest fund. Okay, you will find, like, for example, the fund like Axis Long Term, where, we have put most of the money in past in this fund. Okay, which is 31,000 crores. Okay, so this fund, if you look at the return of this fund, it is not, it is underperformed the market. But, since it was performing very well in the last 3-4 years, so people have put a lot of money into this fund. But today, as we stand, it is basically not the Axis long-term fund, but it is the quantum fund which is giving you the highest, kind of this thing. So quantum fund is, though it is having only 2,000 crore rupees invested of the people, with having a, a good beta less than one, very high Sharpe ratio. Okay, Gen Alpha is also close to about 18%, and trainer ratio is also very good. Of course, it comes with a higher standard deviation, but since we are invested in a portfolio, since we are not only invested in only one plan, we are invested in so many, so we should be more bothered about the beta. And always remember, the higher the risk, the greater the chances of getting the return also. Okay, so we should look at a balanced kind of a view about this thing. So quantum seems to be today the best. So if anybody asks you, where should I park my money to save my income tax? So your answer should be quantum tax plan. Okay. And then, of course, you can have, say, an SBI tax advantage and Sundaram long-term tax advantage are also good. So they can choose any, because it always doesn't happen that the one fund is going to perform always better. Like in past, the Axis long-term was the darling of all the investors, so people were putting money there. But now they're burning their fingers because it is not growing. Okay, so we can just look at for example, we can look at now, apart from this, you should always look at let's go back to for example, let's go to now ELSS and go to the return category or returns here. So sometimes which fund you should avoid. Okay, so then you can just sort it on the basis of 6 months on a downward side. Okay, so funds like Axis long term, which I told you, this is an ELSS fund which is giving only 9.78 return as compared to a quantum which is going 18%. So this is the fund where maximum money has been put by the investors, but it is underperforming the market. It is even given negative returns in 1 year time frame. Okay, year to date, it is the only fund which is giving you the negative return. Okay, fine. The highest return, negative return, is given by Axis long term. Is that clear?
Yes, sir.
Okay, now we move on. Yeah, now we move on to hybrid. Okay, so hybrid funds. Can you just read out what are the hybrid funds? Then name the various hybrid funds. Sakshi.
Yes, sir.
Yeah. Just read all these name of the schemes under which we have the hybrid. How many schemes are there?
So aggressive hybrid fund, dynamic asset allocation or balanced advantage, conservative hybrid fund, multi-asset allocation, arbitrage fund, capital protection funds, and equity savings.
Okay. So aggressive, hybrid funds. Now these are called hybrid funds because they invest. These are also called balance funds. Originally, they were called balance funds because they put money both in equity and debt. Okay, so they will combine equity and debt and invest into them. Now, an aggressive hybrid fund would normally put a lot of money into equity, fine, and less on debt. So you can just read it here. Read it, Sakshi here. Aggressive fund, what is written?
These mutual funds invest in both stocks and debt or bonds. However, focus on stocks is higher with 65 to 80% of total investment in stocks and rest in bonds.
Okay, so these are basically investing most of your money into equity, and if you go to the conservative fund, then look at where they are investing. Just read it.
These mutual funds invest in both stocks and debt or bonds. However, focus on bonds is higher with 75 to 90% of investment in bonds and rest in stocks.
Now tell me, without even looking at how much return these funds have given, which fund is going to give you higher return in good times, aggressive or conservative, and why? Which fund is supposed to give you a higher return in good times? Will it be aggressive or will it be conservative?
Aggressive.
I'm asking this question. And why?
Because it involves higher risk as well. So they invest in those stocks which seems to be growing at a faster pace, and they take out money from that stock which has stagnant growth, or they have stopped and put those money in another stock which will grow aggressively in future?
Okay, fine. So one thing you are not, forgetting is that aggressive funds invest most of their money into equity compared to the conservative. So that's why the aggressive funds will have a greater return in good times. But in bad times, which will fund will be better, conservative or aggressive? Conservative, because here why it will be better conservative?
Bonds, they are usually invested in
Because of
lower risk.
bonds. Yeah. This is because it is invested in lower risk securities. Okay. Now there are arbitrage funds and there are capital protection funds. So first I'll cover the capital protection funds. Okay. Okay. So let's go to capital protection funds and then we'll come to arbitrage after that. So is there any commentary there? No. Okay. Now what happens is I'll just tell you here through an Excel sheet. So let's say, a capital protection fund. Capital protection fund. Now, these are funds where your capital is protected. The fund manager will tell you that you will not lose your money. Okay, fine. Now, I just forgot to tell you that there are two kinds of fund: open funds and close-ended funds. Open-ended and close-ended. First of all, we must know these two funds. So there are open-ended funds and close-ended funds. Now, open-ended funds are open all the time. You can buy them, you can redeem them anytime. Okay, they will be always available in the market. If you choose, you want to buy, you want to invest into any fund, you can invest. Okay, anytime. And you want to exit anytime, you can exit. But in a close-ended fund, they are generally for a certain period. For example, it can be for 3 years or can be 5 years or can be 7 years. Okay. So these funds take the money at the start and then they get closed. So that means you will get your money only after 3 years or 5 years or 7 years. Okay. Now, just listen it carefully and, reply to my questions. Okay. Now, these funds, since they are closed, okay, so they are two, the SEBI says they should be listed on the stock exchange, So they should be listed on stock exchange, or, the fund should have, fund should open for a week or so, after a certain period, after say a year. I'm just putting a hypothetical number, a year. So that means these funds should, give an exit opportunity. So that means they should give an exit opportunity to investors. Which means if the fund is come for 3 years, so after 1 year, they will, give an exit opportunity to investors. They'll open for 1 week and ask the people or the people who have invested, if they want to exit, they can exit. Okay. Suppose I need my money, I can exit through this route. Okay. And after 1 week, it will get closed. So this scheme will not, allow anyone to enter, but only you can exit from this fund. Now, or it should be listed on the stock exchange. Fine. Now, these both the funds are supposed to announce their NAVs. Okay. I'm just putting here. They are supposed to announce their NAVs. Okay. That is the value, at what they are prevailing today. So it can be 10 rupees, it can be 12 rupees, depending upon. Okay. So this has to be done every day. So every day, daily NAV. Fine. And they have to announce monthly NAV. So every day at 9 o'clock or 10 o'clock in the night, the open-ended fund announces what is the current value, what is the current NAV. It can be 55 rupees, it can be 70 rupees, it can be 20 rupees, depending upon how the market has performed. Okay, and will be having a monthly NAV. So that means they will not be announcing their NAV every day, but they will be announcing either monthly or weekly. I don't remember. Okay, so it can be even weekly. So we'll check on the SEBI requirement. So they will be either monthly or weekly NAV announcement. And then if the close-ended fund is not providing any exit opportunity, then they should be listed on the stock exchange. Okay. Now, for example, let's say there is a close-ended fund which NAV announced is say 21 rupees. Okay, fine. So this is what the NAV which the fund house has announced. Fine, but on the same day, the market value on the stock exchange will be, I say market value is 19 rupee 75 paisa. Normally, the market value on the stock exchange will be lower than the NAV announced by the fund house, because people who want to sell their fund because they are desperate, they need money. So normally these funds will be trading below its NAV normally. Okay, because here people are looking to exit out because they don't have any exit opportunity given by the fund house, so they can only exit through the market route. So when they go and look at the market price, they'll find that it is trading generally lower than the market value. Maybe this is the difference. Okay, fine. Have you got it? Now, can somebody summarize what are open-ended and closed-ended in your own language? So just one features for all. Everyone. Divya, anything which you have learned, what is open-ended and closed-ended? Any one feature. Prachi, Ridhima, Rupak, Sakshi, anyone can go. Or Sai, you can tell.
Sir, for open-ended, you can invest in any period, but in the closed-ended mutual funds, you have to invest at the starting of the period, and it you cannot
Okay,
retrieve your
wonderful,
money.
wonderful, wonderful. And next, please, anyone. Sakshi, you are telling something?
So I think same to what Vyom was saying, like open-ended, you can take out your money whenever you want, like there's no restriction. But whereas in
Okay,
close-ended, you have like if whatever period you have put in your money for, you can't take it out before that. And like what you were saying that
very
the
good.
NAV is announced every month for the open-ended funds.
Okay, compared to NAV of open-ended fund will be when? Month or every day?
Sorry, sir?
For open-ended, the NAV is announced monthly or
Daily,
daily? And for close-ended?
monthly.
Okay. So what is the other feature? Teja? Now tell me, there are two options given by the stock exchange to these funds. What are the two options? Now, the stock exchange, the SEBI says that either these funds which are close-ended should be listed on the stock exchange so that anybody who wants to sell can sell it to the stock exchange, or the stock exchange or the fund house should provide them opportunity, a weekly opportunity after a year or so that these funds get open and then a person who wants to sell can sell these, redeem these funds to the fund house. Okay, so that they can, get their money back. So there are two opportunities. One is provided by the, now can you repeat that, anyone? Prachi, Divya? So how the close-ended people can get their money? What are the various options through which they can get the money? If suppose I'm holding a close-ended fund, I need my money. The fund is for 5 years. It's almost 2 years now. So how can I get my money back? What are the options available to me as per SEBI?
Sir, sorry, I missed.
Ah,
So it would be either they should be able to sell it in the next 1 year, so they should open it after 1 year, uh, so that they can redeem, or
okay.
for open-ended, they can trade. That's right.
Not open-ended. Close-ended can be traded in the stock
For
exchange.
Close-ended, they
close-ended,
should be
there
able to
are
trade.
two options. One is provided through stock exchange so that the people can sell on stock exchange and trade them. And second option is provided by the fund house so that after year or so, the people who want to take out their funds or invest, they can do that.
Okay,
Okay.
Akshay, very good. Now, now tell me, where if it's a close-ended fund, okay, if you go to the stock exchange, you will find the price, lower than the, the NAV declared by the fund house, or it will be higher than
It would be
than the
lower.
NAV declared by the fund.
Market value would be lower than the NAV declared by the fund house.
Why so?
So at one time.
Because people would be only people who are willing to sell, who are desperate to come out of the fund. So they will be willing to pay a lower price than the NAV announced by the fund house. So that's why they will be trading at a lower than the NAV declared by the fund house. Okay, so these in the market, these they will get a lower rating or a lower price in the stock exchange compared to what they are actually been announced by the fund house. Okay, because here the people are more desperate, so that's why the price will take a hit in the market. Okay, fine. Is that clear? So should we
Sorry.
have a break for some time? Tell me, Sai.
No, sir. I followed.
Okay, so now it's 10:20, so we'll meet at 10:40 again. Is that okay?
Sure, sir.
Okay.